Now available on Tata Sky channel number 526.
Long-term capital gains are short-term. TDS, service tax or VAT. If you have any query related to taxation in real estate, then you've come to the right place. A very, very warm welcome to you. You're watching Magicbricks Now. This is India's first property channel, and this is Property Hotline with me, Kavita Krishnan. We're answering all your tax queries today. In the studio is Jayesh Kariya. He's a partner, international tax and regulatory at BSR Associates. He joins me, like I said, in our Mumbai studio. Welcome to the show, Jayesh.
Hi, good evening, everyone.
Let's start with our first question. We have Yasin, who's called in from Bengaluru.
Okay.
Yasin, how can we help you?
Yeah, please. I want some clarification.
Yes.
If there are two brothers as co-applicants and co-owners of a property,
Right.
for which they have taken a home loan of rupees 1 crore 89.50
Right.
and are paying EMI of rupees 1 lakh,
Right.
what tax benefit they will get individually so
Right.
far as repayment of loan and this interest thereon is concerned?
Right.
Right.
Okay.
So,
So,
Yasin
what I
essentially
understand your
wants to
question
know,
that you are
right.
two brothers. Both
Yeah.
of them have taken loan independently and invested in a flat
They have
which is
jointly
joint.
taken a loan. They have jointly taken loan.
Right.
They are co-owners,
Right.
having joint account.
Right.
So they are paying 9.5% interest, and
Right.
EMI is 1 lakh rupees.
Right.
What tax benefit they will get individually? I want to see.
Okay. So,
So
see,
far as
in terms of
repayment
the
of-
agreement, Yasin, if both of you are the owner and both of you are the taxpayer, and both of you are, like example, say 50% owner of the property, and both you are going to kind of fund the, I would say, the loan or repay the loan out of your own earnings, then both of you can claim the deduction which are available under the income tax law. There are two, I would say, the benefits that you would be entitled to. One benefit is like the payment of the principal amount, and the second one is in relation to the interest. As far as the principal amount is concerned, you are entitled to a deduction of up to 1,50,000 under Section 8IC of the Income Tax Act. And as far as the interest is concerned, you will be entitled to interest deduction under Section 24 of the Income Tax Act. Now, if it is a ready property, then obviously you'll be entitled immediately. But if it is like an under construction property, then you would be entitled to deduction of the interest under Section 24 over a period of 5 years after the house is constructed. So you have two
Jayesh,
benefits. Right,
Yasin
Kavita?
had a very interesting question. He
Yes,
also
Kavita.
said categorically that both of them are paying the EMI from a joint account.
Right.
Now, in this case,
Right.
will both of them still continue to get the tax benefit? Since it's a joint account that you're talking about.
Yes, Kavita. See, the account being a separate account or a joint account, I think it's not an important issue. It's just a substance over form. So in substance, if both of them are, I would say, paying the EMI or the I would say the any other cost in relation to the purchase of the property, and both of them are equal owner of that property, then yes, both of them are
No,
entitled
but,
to. But
just-
if they are, like, take an example, joint owners, and the entire property is being purchased by one brother, funded by one brother, EMI is being paid by one brother into a joint account, and the other brother is just only a kind of a joint owner, and he is not paying anything out of his kind of own earnings, then obviously both will not be entitled.
So
I'm
are you
presuming
saying
both-
that they have to show a paper trail, which is what I want to know. In a joint account,
Right.
now the account is in both their names. You
Right.
don't really know where the money is coming for
Right.
into the joint account.
Right.
Do the brothers here, in this particular case,
Right.
have to show that, both of them are in fact depositing a specific sum of money on a monthly basis in that joint account,
Yes.
which is then going towards the home loan?
Of course, because that paper trail is very important. Otherwise, how do you establish that the money which is going into the joint account is coming from two different people, right? So therefore, your question is very valid and concern is also very valid. It has to be demonstrated that both are funding the purchase of the property. It's only for the administrative convenience that there is a joint account.
Wouldn't it be far more simpler from the tax perspective to have two different accounts?
I don't think that's going to matter anything. Unless if you are able to justify, then I don't think that's going to matter anything.
Right, Yasin? So the answer is both the brothers can, in fact, claim tax benefits. However, you also have to ensure that there is a paper trail showing that they are, in fact, both of them are repaying the EMI. Let's move on. We have another caller on the line. Melville has dialed in from Mumbai. Melville, how can we help you?
I'm calling regarding my wife purchased a flat in 2011, and she purchased it for 15 lakhs, and she sold it a few days back for 38 lakhs.
Okay.
So to avoid tax, I want to know how to invest this money.
She sold it for 38 lakhs, bought it for 15. She's made a sizable profit over there. How does he invest this money so that he doesn't have to pay capital gains tax?
So first of all, congratulations that you made 3 times money. So invested in 2011, that was a difficult time. And today also when you are selling, it's a difficult time. So you still made 3 times money. So congratulations to you and your wife for this. Now, since it is a sale of a flat for 38 lakhs and the cost of which is 11 lakhs, the difference between 38 lakhs minus the indexed cost of 11 lakhs, say assuming that index cost would be around say 18 lakhs, so that 20 lakhs is going to be a capital gains, which is subject to long-term capital gains tax because you've been holding the property since 2011, more than 3 years. And the capital gains tax would be taxable at the rate of 20%. Now, if you want to save the tax of whatever on the 20 lakhs capital gain, then you have 2 options. One, the first option is that you invest in another residential house so that you are entitled to a deduction, say assuming that you entirely invest 20 lakhs or 22 lakhs into a new home, then the entire capital gain of 20 lakhs will become exempt under section 54. The time limit is 2 years from the date of the sale of this property. Or you can invest into a bond issued by the infrastructure company like National Highway Authority or the Indian Railway bond, which are available. And there you can invest up to 50 lakhs and 20 lakhs is within the limit. So in that case, your entire capital gain would be exempt. So these are the 2 ways in which you can save your taxes, and you can decide the way which is, I think, convenient to you depending on your financial position.
Jayesh, you did explain the formula very clearly, but if you could just break it down a little further.
Right.
What does a lot of people are confused as far as long-term capital gains tax and the reinvesting bit is concerned.
Okay.
Do they have to reinvest the entire sale proceeds in a capital gains account, in bonds or in real estate, or do they need to just invest the profit that they have made? If you could just break that down a little further for our viewers.
Okay, sure. So as far as the benefit under section 54 of the income tax code is concerned, which talks about reinvestment in the property, there it says that you have to reinvest only the capital gain. So which is up to 22 lakhs if you invest, then your entire capital gain is exempt. But under a bond, which is a 54E code, which talks about the investment of the sale consideration. So there, if you want an exemption of the entire 22 lakhs, then you have to invest entire 38 lakhs into the bond. So that's how I would say the computation mechanism will work to claim an exemption from the capital gains tax.
Right. With that, let's move on and take an email query next. Vipul Swaroop, has written in. He says he purchased a flat in Navi Mumbai in January 2016 for 55.5 lakh rupees.
Very interesting.
Now, Vipul paid 1% TDS on the property via internet banking.
Right.
He inadvertently paid this TDS twice on the same property.
Okay.
Now, when he got in touch with the builder to claim the refund of the additional TDS amount that was paid, the builder was not willing to cooperate. He wants to know how he can claim this refund. That's because he got in touch with the wrong person. He has to get in touch with the tax agency, right?
Interesting question. Now, I would like to say that this is something, a difficult situation, Mr. Swaroop, for you. The law actually does not provide, I would say, too much flexibility for the refund of the tax which is being deposited twice with the revenue authorities. The law provides for the refund in certain situations. So the Central Board of Direct Taxes has issued a circular, but your situation is not covered by that circular. So technically, you cannot make a kind of a claim for the refund under the income tax law. The practical way out is that since your developer is going to get a credit for the double tax that you paid, so you can ask for a refund from the developer. That's I would say, the practical way of getting a refund. You can try, which is something I know it is not written in the book, but you can still try and meet the tax officer and make a request to say that this is something which has been paid twice, and it's a mistake, so therefore this money belongs to me and should be refunded.
Now, Jayesh,
depending on, I don't know how the tax officer is, I would say, but it is not in the rule book kind of, Kavita.
Right.
Yeah.
Jayesh, what I want to ask you is this. I know
Sure.
that if you pay the TDS, you do get a receipt at the end of it,
Right.
saying that you have paid TDS.
Right.
Even if you're doing it on internet banking.
Right.
Now, like he's saying very clearly, he's paid it twice.
Right.
So he would have 2 receipts.
Right.
He has proof that he's paid it twice.
Right.
Can't he go to the tax departments, the tax authorities, and show them that here's 2 receipts
Right.
generated by your own website, which
Right.
says that I've paid the tax.
Right.
Now please refund me my money. Why does he need to go running by the developer for it? And the developer clearly doesn't want to cooperate, which is what he's saying.
Kavita, I understand this is a pain area kind of, but the law does not provide for the refund once it is paid, because this TDS mechanism of the real estate property is not a full-fledged return which is to be filed by the payer, because there is no tax deduction account number needs to be obtained. It's a one return cum challenge which is to be deposited, and there is no provision in the law for revising and asking for a refund. So that's what I'm saying, that you can reach out to the tax officer. If the tax officer is bold enough, then he might consider it and give the request. But the chances, if you want to see on a scale of 1 to 10, I would say it's less than 2 kind of. I don't think, because the tax officer has kind of any avenue to take that position also. So the best remedy is to go to the developer, and if you have to pay additional money to the developer, then make an adjustment against that TDS amount.
And some really bad news coming in for consumers there. So if you are buying a home and you have to pay TDS on it,
Right.
Be very, very careful, pay and ensure that you pay the TDS only once. 1% on a property worth over £1 crore is quite a huge sum of money, and the tax department is not going to refund that money. It is daylight robbery, but there you have it. And let me tell you this, on Magicbricks Now, we will try and take this up as well. In the meanwhile, let's answer a question that's coming in on our website. Renukananda has written in from Bengaluru.
Right.
Now, he says that he owns a residential house in Bengaluru, which was gifted to him by his sister in 2015. Now, his sister's son, that is his nephew, originally bought this house in 2002 and gifted it to the sister.
Right.
That is the nephew's mother in 2015. If Renukananda sells his property now, what will the tax impact be on this, on him, obviously?
Okay. So Kavita, let me just demystify the question. Kavita has got a property from the sister as a gift in 2015, and that property was received by her sister by way of a gift from the son, and the property was bought somewhere in 2002. Now, there are 2 situations. One is, the question is, when Kavita received the premises or property, whether there is a taxability or not. Now, section 56(2)(7)(b) talks about the taxability when individual receives certain property without any consideration or as a gift, then there is a taxable situation. But the law provides, I would say, certain exclusions to say that if you receive from a close relative that property, then there is no taxation. So first of all, I would say the good news that when you receive the property as gift, there is no taxation. But when you sell that property, yes, it is a transfer, and the money that you receive, there is a capital gains taxation at the point of sale. Now, how do you compute the capital gain tax? So you one hand your sale consideration that you receive, and then you reduce the cost, right? So in your example that the property has been purchased in 2002, so the cost would be the cost of the previous owner, and the previous owner is not your sister, but the previous owner is the son, because he also had in turn gifted. So it will go back all the way to the cost which has been incurred by the son, plus any additional cost which has been incurred in terms of major repair or getting the title done, and all those costs all will be added as a cost. And then you will be entitled to the induction benefit right from 2002 till 2016. And then whatever the capital gain that is being computed, that capital gain would be treated as a long-term capital gain, because the period of holding also will go back to the year in 2002. So effectively it's like 14 years, so it's a long-term capital gain. So that long-term capital gain will be taxable at the rate of 20% in the hands of Kavita, right? Now, as I said a few minutes ago, that if that capital gain is invested into another property, then you can claim an exemption under Code 54 of the Income Tax Act. But if you are not investing, or if you are investing in a bond or something of that sort, then also you are entitled to exemption. But then when you are investing in a bond, then remember you have to invest the sale consideration, not a capital gain. So this is my short answer or brief answer for Kavita.
And if I can further simplify it for you,
oh, great.
Essentially what Jayesh was trying to tell you here is that the cost of the property which you will need to take for indexation, and which is essentially the base from which you calculate your capital gains, is the original cost that your nephew paid for it when he bought this particular property. Now, a gift is not taxable, so there is no tax liability over there. However, if you choose to sell the property, you will have to pay capital gains, and you'll have to pay long-term capital gains tax on it, which again you can calculate starting from that particular base year, which is 2002, which is whenever your nephew bought that particular property. You know, before we move on to the next question, and I know that our phones are ringing off the hook. This is what I'm being told by my producer. But very quickly, Jayesh, there's something very interesting you said. You said that when I calculate capital gains, it is not just the cost. It is cost plus whatever other charges I pay to transfer the title. Does that mean that if I'm paying the money that I'm paying, and it's a substantial amount that I'm paying for registration, for stamp duty, can I also include that when I'm calculating capital gains?
Yes, very much, because that is a cost. Like when you're transferring the property into two-time transfer has happened, and if there is a kind of any cost which has been paid to a society for change of name, or to the registrar for change of name, registration fee and all those, and assuming that you would have done a kind of a significant improvement to that property, right? So like it was in a 2002 and now it is 2016, there are a lot of I would say repair work that needs to be carried out, major repair to bring the property to a habitable situation or a sale condition, then even that cost also can be considered as part of the cost.
So very simply, any renovation work that you can do can be added.
Not any
also,
and all, but significant.
Yeah, significant renovation work.
Absolutely.
And also in a way, what the taxman takes, he also gives you back. You can add the stamp duty and registration charges when you calculate capital gains tax. I am told JD Bhattacharjee is called in from Mumbai. How can we help you, Mr. Bhattacharjee?
I've got an inherited flat which has come up for redevelopment. The developer is paying some compensation towards hardship and rent and all that. Now I want to know whether that amount paid is taxable.
Now this is a question that most of Mumbai wants to hear the answer to.
You're
Jayesh.
right, Kavita.
A lot of buildings are going in for redevelopment.
Right.
Do they need to pay tax on the rent or on the hardship allowance that the developer gives them?
Okay, so Times of India also will have the question when this property will go for redevelopment. So your question is that you have got an ancestral property as a gift, and that property I believe is a part of the cooperative society, or is it an independent bungalow? So if it is an independent bungalow and you are the owner, or if you are a kind of a society, then there are a little bit complication, but assuming that let's stay with a bungalow or an apartment and then stick to your situation.
We can ask him. In fact, Mr. Bhattacharjee is on the phone line.
Okay.
Mr. Bhattacharjee, tell us very quickly, is this an independent bungalow or is this a housing society?
It is a housing society.
Okay, so it's a housing society, so you are the owner of the apartment, you are not the owner of the land, because the land does not belong to you under the MOFA in the Maharashtra Flat Ownership Act. Now, what the law says that when you give your right, or when you give up your right in your own apartment and it goes for a redevelopment, and in return that you get a property or a flat of the equivalent size or a bigger size, then that tantamounts to technically that tantamounts to a transfer, because you are giving a right in your property in exchange for another property that you are getting. Now, therefore, there are a lot of judgments which has taken a view, courts have taken a view that it is a transfer, and therefore there is a capital gains tax liability that gets triggered. So the market value of the new property that you get it minus the cost of your existing property that you bought will be regarded as a capital gain, and that capital gain get taxable. But you don't have to worry about paying taxation at this point in time, right? Because what is happening that you are you are giving up this right, and immediately you are purchasing a residential property. So therefore, one property is being sold, another property is getting purchased. So you can take a rescue under section 554, code 554 of the Income Tax Act, and say that my entire capital gain is reinvested into another property, and therefore there is no capital gains tax. Now coming back to your point on a compensation, I believe compensation is in the form of what you call it as a reallocation or shifting allowance, or a rental that the developer is paying for you to, I would say, have an alternate accommodation, right? So that one can take a position that the amount which is being paid by the developer for relocation or for a rental payment for your alternate accommodation is nothing but a reimbursement, and therefore that should not be taxable, and that should not be treated as your income, and you should not pay tax. So you can rely on some of the court decisions which have taken a view that that is not an income, that's just a kind of a hardship allowance or a reimbursement.
So how do they essentially prove this, Jayesh? Because I'm sure this is something that will come up the year later, in the next year, when you actually go and file your tax returns, and you have to answer as to where that income is actually coming from.
Right.
So do you need to show the agreement, or do you need to make a separate agreement for, which lays out very clearly what the developer is going to pay you as rental or as hardship allowance? Is that necessary?
Very interesting question, Kavita. In a redevelopment, what happens that generally there is a tripartite agreement which happens between the developer, the cooperative society, which is the owner of the land, and the individual flat owners. And in that agreement, everything is being recorded in terms of what is being exchanged for, what is being given, and what the society is going to get it, because society also gets a lot of extra money as a deposit or as a kind of corpus fund and so on and so forth. And also what each property owner or flat owner is going to get it. And even the rental and all other reimbursement, additional
so
compensation.
does he have to show the agreement?
Of course, that agreement
He has
needs
to
to
show
be
the
shown.
agreement
And
as proof,
plus
and then
it all depends on, developer might have his own apartment and he might provide alternate accommodation, or developer might have a direct rental arrangement and he might pay direct rental to the property
you need
owner.
to get your paperwork in
so paperwork
place
is very important.
to ensure that you have the right answers to give to the tax authorities. Let's take an email query next. Sridhar AS has written in. He wants to know if capital gains received from the sale of property can be used to pay a home or a land loan, and can he claim capital gains tax benefits on that? So can he use that to repay a loan?
See, when you receive a capital gain on sale of a property, and if you apply for the repaying of the loan, then unfortunately you don't get any benefit at all, because that's a replacement of the old loan which you would have taken. I assume that whatever the loan that you would have taken in the past for purchase of the earlier house, right, not the house that you sold, then you would have claimed I would say some or the other benefit. Or when you are paying when you would have taken a loan and you would have paying the EMI, then you might be claiming the, I would say, deduction under section 8IC in respect of the principal amount, and for the interest you would claim under section 24 or code 24 of the Income Tax Act. So these are the only benefits I would say. If you would not have claimed, then you should look at it and claim it. But the capital gain which you are using for repaying the loan for the purchase of a home or land, I don't think that is eligible for any tax break at this point in time.
Okay, so no tax breaks over there. Let's take a question that's coming in on our website now. Nilesh has written in from Kolkata. Now, Nilesh bought an apartment in Kolkata for 50 lakh rupees in 2012. The current value of the apartment is around 1 crore. He wants to sell this apartment and move to a smaller apartment that would cost him around 60 lakh rupees. Now, he wants to know what his tax liability will be and if there is any method to save tax. Now, people generally move to a far more expensive and a larger home. He's taking a step backwards. Can this also qualify as, can he ask for deduction over here?
So your question is that you are owning house which is worth 50 lakhs, which is worth, cost is 50 lakhs and you are selling it for 1 crore. So you are making a capital gain of 50 lakhs. And now you are investing into another property which is a small property which is going to cost you 60 lakhs. Now here, yes, certainly there is event which is happening, and therefore there is a capital gains tax liability. So your sale consideration of 1 crore minus index cost of 50 lakhs, I am presuming that index cost is about say 65 lakhs, so your capital gain is 35 lakhs, which becomes a kind of a taxable capital gain. But since you are buying another house within say next 2 years or immediately, and you are investing 60 lakhs, which is more than the capital gain that you want. So your capital gain is 35 lakhs, your investment is 60 lakhs. So therefore you are entitled to exemption of the entire 35 lakhs under Code 554 of the Income Tax Act. So therefore you don't have to worry about paying any capital gains tax
Right,
at all.
Nilesh, and essentially what you
So it's
need
a
to
good
remember is that you have to reinvest your gains, which is the profit that you made, and not the entire sale proceeds. With that, we come to an end of the show. That's all the time we have for on today's episode of Property Hotline. Jayesh Kariya, thank you very much for joining us. If you have any questions related to real estate and anything under the sun about whether it's buying, selling or investing in property, whether it's legal issues, whether they are home finance queries or tax queries, you can reach us on the IDs that are flashing on your screens right now. We will get the country's top experts to answer them. That's a promise. Keep watching Magicbricks Now.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.